Hi, it's Sophie here from Smith Investments. I'm going to talk you through our key principles to investing in property, which will ensure any property investment you make will be profitable and provide secure long-term returns. First off, we recommend you always buy at below market value. This means you're securing equity at the point of purchase, which helps protect your investment against any downturns in the market. This also means if we refinance your property, we can reuse your deposit to buy your next property, creating infinite return on investment. Our next key principle is to add value. When we talk about adding value to a property, we renovate or extend a property to increase its value. Similar to buying below market value, if we add value to a property, this can increase the amount of equity we have in the property, therefore improving cash flow and protecting against any downturn in the market. At Smith Investments, we would recommend you invest for cash flow. We ensure any property purchase for you is cash flow positive after all costs, including letting agent fees and buildings insurance, and not just rent achieved versus mortgage payments. A property must produce a good cash flow to allow for essential repairs and maintenance. This also gives our clients money in their pocket each month, as well as capital growth over time by holding the property. While many average investors buy a property where rental income covers mortgage payments, unexpected costs can leave them out of pocket. We all know what problems can arise in rental properties: boilers breaking, washing machines leaking, so we always recommend our clients put 10% aside every month into a rainy day fund for a cash buffer. We always buy for yield or cash flow, not capital appreciation. Many investors base their entire business model on the capital appreciation of a property and underestimate funding in the shortfall in running their property portfolio. This is a very big mistake and a very high-risk strategy to be avoided at all costs. We purchase property on the basis that property prices will never rise, meaning your model is based on instant profitability, income from rent, not just growth. At Smith Investments, we carry out thorough due diligence on any property we are considering for our client's portfolio. This due diligence covers, first of all, the property. Is it worth as much as it's been valued? How does it compare to other properties sold nearby? How much would it rent for? We would also get a builder's report for renovation costs prior to making a purchase. Secondly, the numbers. What are the renovation costs and acquisition costs? How much would the property be worth once renovated? Do the numbers work as a buy-to-let or a buy-to-flip property? We always crunch the numbers on two exit strategies. Lastly, the deal. Fit the deal in question to a client strategy. If the deal does not fit our client strategy, then we do not make a deal. Be prepared to walk away if the deal doesn't fit perfectly. While we previously discussed investing for cash flow, we also advise our clients to invest for the long term. The mix we often see is investors intending on investing for the long term, but quickly changing their mind. Unfortunately, we see this often. Investors make a snap decision to buy a property, realize the figures don't work, and sell it after a few years worse off than where they started. Previous property cycles have shown us property increases in value if held for long periods of time. Therefore, if our clients decide to invest for the long term, we ensure the numbers work. At Smith Investments, we advise our clients to buy existing, older properties. The right type of property can make you thousands every year for the rest of your life. Existing, older properties are safer to buy for a few reasons. They have established values over a period of years. There is no immediate depreciation, a bit like when you would drive a new car out of a showroom. There is limited availability. What we mean by this is there are not 100 more being built down the street. Because they have been around for many years, the properties are often more robust and less likely to have snagging issues. We always recommend to invest in what you know. We buy properties for our own portfolio and for our clients' portfolio in local areas where we know property prices, we know the market, and we know we can make good profits. We would not recommend buying overseas unless you know the area very well, or buying off-plan or out of area. These deals tend to carry more risk. And lastly, never ever buy on emotion. We only buy properties that fit our investment criteria. Do not make the mistake of getting drawn into looking at big, colourful lifestyle brochures, new builds, and dreamy holiday homes. While these places may look nice, we are not investing in properties for their aesthetics. We hope you have found this video useful in highlighting some important investment principles. If you'd like more information, click the link below to book a call with us. Thanks for watching.